Is there a major shakeup ahead? How this week's rate rise and the budget talks could shape your next move. Hey everyone, welcome to the iStrategic weekly newsletter for Friday the 8th of May. Well, what a week we're in. We're sitting right in the middle of two major events for the property markets. On Tuesday, just gone, the RBA lifted the cash rate another 0.25%. And next Tuesday night, we'll see the federal budget handed down, and with it, potentially some of the biggest changes around property tax policy that we've seen in years. There's been a lot of media commentary around negative gearing and capital gains tax changes. But when you strip away the headlines, I think the more important conversation is this. Simply, how will these policies actually affect buying behavior, supply, and long-term market dynamics? Because as we know, property markets don't move on headlines, they move on incentives, affordability, credit, and the supply-demand imbalances. The latest rate rise is really about borrowing power. So let's deal with that first. The RBA's latest 0.25% increase was largely expected after inflation came in stronger than anticipated, with CPI rising 4.6% over the March quarter. Now, for investors and owner-occupiers, the immediate impact is fairly straightforward. Your borrowing capacity has reduced again, roughly around 5% on average. And for an average $1 million variable rate mortgage, it will now cost you another $120 to $160 per month in interest. And buyers at the margins are becoming increasingly price sensitive. Now, what's important here is that higher rates don't impact all markets equally. Affordable markets with strong rental demand tend to remain more resilient because buyers can still service the debt, and higher rental yields help offset the holding costs. More expensive markets, perhaps where the yields are lower, where buyers are already heavily leveraged, they may feel pressure more noticeably. That variation is something that many commentators miss when talking about the property market as if it's one single entity. Again, I talked about that a lot last week, about Australia being a multitude of different markets to be treated differently. Next, negative gearing changes could shift investor demand. Well, the biggest story right now is clearly the upcoming federal budget. Based on the media leaks so far, there are discussions around limiting negative gearing to two investment properties, potential changes to the CGT discount, either abolishing it or moving it from 50% to 33% or 25% even, and possible exemptions or incentives for new construction have been talked about as well. Now, one of the key questions is whether any changes would be grandfathered. In other words, would the rules only apply to purchases made after the policy date, or would they impact existing property owners as well? That distinction matters enormously for investor confidence. So it'd be good to just get it out of the way and get some clarity on budget night. What's particularly interesting for me is the reported discussion around carving out new construction from any restrictions. Now, in my view, that would make logical sense. The government has repeatedly acknowledged Australia's housing undersupply problem, and encouraging capital towards new housing stock rather than discouraging investment entirely may be one way to balance revenue goals with some of the supply pressures. If that happens, we could see investor activity demand gradually shift. Less competition for established dwellings, firstly, more competition for new builds and development stock, some upward pressure on construction pricing with the increased demand, and possibly increased investor focus on new and off-the-plan properties. Now, that doesn't necessarily mean existing property suddenly falls in value, but it may create greater divergence between different asset types over time. Next, tax policy alone is unlikely to fix housing. Now, one thing that stood out this week was listening to the Treasurer, Jim Chalmers, acknowledging that changes to negative gearing or CGT concessions are unlikely to create an immediate budget windfall. That's important because some of the public discussion around these policies can imply they're a simple fix for broader affordability or fiscal issues. Most economists would agree the reality is far more nuanced. The Grattan Institute has estimated that reforming these concessions could save the government around $11 billion annually, arguing that the benefits disproportionately favour high-income earners. While at the same time, Australia still faces extremely low vacancy rates, strong population growth, persistent constraints on construction and new land supply, and a significant shortage of overall housing. And in property, supply-demand pressures tend to dominate long-term pricing trends far more than short-term policy. Now, what this means for investors. So far, property prices haven't meaningfully reacted to the speculation around these changes, which isn't surprising. Property is a slow-moving asset class. Markets usually need time to assess whether policy changes actually happen, how they're implemented, whether they're grandfathered, and how developers, buyers, and lenders in the market will respond. For investors, I think the core principles remain largely unchanged, and this is certainly what I'm telling my clients. Keep focusing on well-located markets with strong demand fundamentals. Prioritize affordability and cash flow sustainability. Avoid overextending your borrowing capacity. Maintain cash buffers to weather higher interest rates. And take a long-term approach rather than reacting emotionally to policy noise. Selection still matters enormously, and it always does. Not every market will perform the same. Not every property type will respond the same. And in this environment, strategy becomes even more important than broad market direction. Finally, there's no question this is a significant week for property investors. But while headlines tend to focus on dramatic policy shifts, the bigger picture remains relatively consistent. Australia still has a structural housing shortage. Rental demand remains extremely strong and borrowing capacity continues to shape buyer behaviour. The investors who tend to perform best over time are usually the ones who stay disciplined, manage their risk well, and avoid making short-term decisions based on political cycles. The next few weeks will give us more clarity on where policy is heading. But until then, I'd be cautious about reacting too aggressively to speculation alone. If you'd like a deeper breakdown on how these potential policy changes may affect different markets and asset types, feel free to reach out. Once again, thanks for listening. Thanks for reading. If you want the article, you can scroll down in my email and you can read it. Thanks and have a great weekend.